This podcast is sponsored by Pogo, Property Operations on the Go. Facility managers know how challenging it can be to keep everything running smoothly. That's why Pogo was created, a white-labeled software solution designed by property managers for property managers. Pogo is your ultimate all-in-one platform for managing multiple assets. With Pogo, you communicate with your tenants, manage maintenance requests, control property access, manage bookable spaces, and much more. Plus, with advanced analytics, Pogo empowers you to optimize your operations anytime, anywhere. The best part? Pogo is completely customizable to fit your brand and business. Simplify your operations, enhance tenant satisfaction, and save money with Pogo. Ready to make the switch? Visit gopogo.us to schedule your demo today. Pogo, one system, multiple solutions at your fingertips. Hello, everyone. I'm Mark Beffort, bringing you relative discussions with leaders in the commercial real estate community. Today, I have a good friend of mine, Todd McNeill, who's with IPA Capital Markets. Been in the business for well over 25 years and have closed in excess of, $6 billion? $6 billion of funding. Welcome, Todd. Glad to have you here today.
Well, I'm delighted to be here. Thank you for having me, and I'm honored to be on your podcast.
Yeah, you bet. So, every business has some form of debt and or equity. So let's set a basis before we get into discussions of really what that means.
Sure.
So debt can come in many forms. So you have bank debt, you have bridge financing, you have a life debt, you have capital markets debt, whether that's a CMBS loan, which stands for commercial mortgage-backed securities, or bond financing.
That's right.
What are the forms of debt are out there? And we're going to get into each one of those.
So you've hit on what we call like the four major food groups. But with respect to debt, especially in today's market, Mark, there's been a big proliferation in private capital. And that was born out of the fact that the banks started losing deposits, and they weren't able to lend the way they used to be and the way you and I thought about banks, say, 24 months ago. So the private capital debt fund market is a space that's just really mushroomed and ballooned in the last really 4 to 5 years, but especially the last 2 years.
So help me out here. So,
Yeah.
so the private capital is really servicing a piece of the business through debt placement. So they'll go raise money.
Correct.
And have a fund that fund's purpose is to loan money.
That's accurate.
So what's the pricing?
So that's a good question. And for some of the cleanest deals, what I would refer to as a leased up multifamily Class A, you're seeing pricing around SOFR 275 to 250. SOFR's at like 4.3%. So you're north of 6.
And that's from the private.
That's from the private capital. But however, we see the majority of the financing at private capital be around SOFR 400 to 550, mainly because if you do have a clean multifamily, you're probably not going to go to a private capital. You're probably going to take it to Fannie or Freddie or some other securitized lender that's able to get much better pricing. And so typically you're not going to be dealing in that arena with a clean deal, as I had mentioned, for the lower tier pricing. So I would say the majority of the private capital is coming in at that 375 to 550 over the SOFR.
Got it. Okay, so take that. So you got bank financing, which is a primary source.
Correct.
And then you have this private capital serving a loan to make our transactions happen. Talk a little bit about a bridge financing. What is a bridge financing?
So bridge financing is, as the name suggests, it's to take you from one place to the next. So typically you would identify or use a bridge loan if you had a property that was built, maybe partially leased, needed to be completely leased, and there might need to be some injection of capital into that building to fund tenant improvement dollars, some CapEx. So you typically go get a bridge financing to take you from that position to a stabilized position, at which point you would either exit that bridge financing or exit the deal altogether vis-a-vis a sale, as you've created the value. And so bridge lending typically is shorter term. 1 to 3 years in term, with maybe a couple extension options to get you to 5. But that bridge lender wants to be in and out in a 3-year time frame, and they're going to price their money as such. So if you were to go back and do an analysis on your internal rate of return on an exit of a deal, usually the cost of capital in that interim financing doesn't move the needle as much as one might think. So bridge financing, as I mentioned, with the private debt funds, prices at that 400 to 550 over. If you execute on your business plan, it usually doesn't matter.
Mm-hmm. Got it. So you said earlier, I thought very interesting. You said Freddie and Fannie. So
right.
It's Freddie Mac and Fannie Mae.
Correct.
And what type of financing do they provide?
Okay, that's a good question. And Fannie and Freddie are very specific, and what they're looking for are stabilized multifamily. Okay. So if you have a multifamily property that's 88% leased or higher, you're typically, what I would say, in the club to go and seek agency financing, which is Fannie Mae and Freddie Mac. Okay. Agency is government subsidized debt in that the government puts a credit wrap around the bonds that they sell, so they're able to achieve better pricing in the market from a capital markets execution. And so that's done to spur housing and to provide housing for many different forms of income. They have all the way from Section 8 to the high-end Class A multifamily that you see around here in downtown Oklahoma City.
Got it. So then the last form, talk a little bit about capital markets. Mm-hmm. So capital markets, from my perspective, I've never done a bond deal, but we've done a lot of CMBS loans, which is...
That's a capital markets transaction.
Yeah. So it's a commercial mortgage-backed security. So are there any other forms of capital market financing outside of those two?
Well, within the capital markets, you do have the CMBS loan, which you mentioned. You do have what we call a SASB, which is a single asset, single securitization. It's for large deals that they'll just securitize on their own. And then you can have... a floating rate capital markets execution that a lot of the debt funds will utilize to kind of repatriate their cash, and they'll sell a floating rate tranche of bonds into what we call a CLO market, which is a collateralized loan obligation. And so you might be dealing with a private lender today that says that they're going to write you a $20 million mortgage. The day that they close, they're going to go sell a big portion of that paper into the CLO market. But they'll stay on as the B note holder, so they retain control of the loan. They're your servicer, but they're selling an A portion into a capital markets execution.
Okay. So this is debt. There's a lot of forms,
right.
and every deal has a different fit within that debt category.
That's
right?
Correct.
Every deal has to have some form of equity into it, right?
That's right.
And every one of those debt requires different types of equity.
That's correct.
And equity purely is money that the borrower actually puts into the deal.
That's correct.
So are there any other forms of equity?
There's all kinds of equity that's out there. The most basic form of equity, and what you're started referring to, we call common equity. Common equity is, as you described, it's the equity coming into the transaction that usually is the basis between where the lender's going to stop funding and where the rest of the deal needs to have capital to make the deal work. There are two other forms of equity that we deal with that I sometimes slang call them dequity, because they are debt providers that disguise themselves as equity. And that is what we refer to as preferred equity or mezzanine lending. And mezzanine lending and preferred equity, there's a couple nuances that are different between the two, but basically what their objective is to come in between the first lien debt and the common equity to fill what we refer to as a gap in the capital stack. And sometimes the gap is created by a multitude of reasons, but in today's market, Mark, what we're seeing, the gap is a result of lenders' last dollar in at today's interest rates is much lower than it was 24 months ago because of the debt coverage ratio that they want to solve to.
Right.
And so that's created a gap between where a typical investor wanted to have an allocation of money into a particular deal, and they need to solve for that. So typically, I shouldn't say typically, but in a normal market, a borrower may come and say, look, lender, I want 75 to 80% debt, and I'll put in 20 to 25% equity. That metric, because of where rates are today, has went from 80 to 75 to 65 to 55 on the first lien side. And so it's created that gap between where the expectation was for the borrower. So this whole proliferation of preferred equity and mezzanine debt has come into the market to solve and kind of close that gap.
Got it.
And they'll charge anywhere from 11 to 12% interest only, all the way up to 16, depending on the inherent risk in a deal.
Sure.
But one may look at that as cheap equity because most equity wants to solve for a low 20s return.
Yeah.
And so
I ask you this question.
Yes.
If somebody's having to borrow money at 16%,
yeah,
it means the deal is probably not that good.
it means the deal is either usually when you see a 16% mark, it's because the preferred equity is so high up into the capital stack that preferred equity provider perceives that they're taking equity risk and they want to be compensated for that. So it doesn't necessarily mean it's a hairy deal.
I got it.
It just could mean that they are so high in the capital stack that they feel like they're taking equity risk and they want to be rewarded for that risk they're taking.
Okay. So everyone has a story. Everyone
Yeah.
has a journey in their life. What was the defining moment that made you decide, or that you decided to get into the finance world of the real estate market?
So I have two older brothers, and they are wonderful human beings. And being the youngest, I got to witness what they went through in school and in life and in early jobs to figure out kind of what was cool and what was interesting. And I had one older brother that was a CPA, worked for Arthur Andersen, and come around tax time, he was working 7 days a week, 80 hours a week, and he went back to school to get his master's degree to go and get away from that business. So I knew I didn't want to do accounting. I had another brother that was in the finance arena that did commercial real estate lending. He's in Manhattan, still doing commercial real estate lending in Manhattan for the last 25 years. And he was the one that I was kind of like, okay, his job seems really cool. And so when I graduated from the University of Oklahoma in late 97, I had a finance degree and I went to Dallas, which is where I'm from, and started working for a boutique brokerage company. And I quickly learned that this was a really good arena for me. And the reason why is because in the brokerage world, as you know, because you've managed brokers, you have a big chunk of your career, you kind of are running your own business within a business. And so it's really up to you as to how well you want to do or how poorly you want to do. And I was a college athlete. I played goalkeeper, and I loved to play goalkeeper because I loved the pressure.
Goalkeeper in soccer?
Soccer.
Okay.
So, excuse me. So, I loved that pressure.
Yeah.
I just loved it, and I thrived off of it. And I was a self-starter, and I wanted to, get into something that allowed me to do that early. And that brokerage is one of the better avenues to make that happen.
So, what's it like when you're a goalkeeper? You're in college. you're in these days. You're paid to perform, right?
Yeah.
Maybe not.
Right. Not like that. Yeah.
Not back when you were in school. But and you got a guy coming at you. He's on a breakaway. No defenders in front of you. What does that gut tell you?
Oh, it's there's nothing better. I mean, there's nothing better because you got an element of butterflies in your stomach, but you know that it's like this is on me, and you got to go make it happen. I loved it. I loved those situations.
Yeah, that's awesome.
And goalkeeper was one of the only places on the field where you could be physical. My parents forbid all of us to play football because my dad's best friend was a orthopedic surgeon, and he told him, "Don't let him do it." And so we couldn't play football. So that was my avenue to be physical, was to be a goalkeeper of soccer.
That's awesome. That's awesome. Okay, let's get into underwriting of a loan.
Yeah.
What are some basic fundamentals that are necessary to have a good beat on in any loan?
Sure. So the basic stuff, you're going to want to have the rent roll, the operating statements, and if it's a construction deal, you're going to want to have the construction budget and the pro forma. But what I would say is, I'm a finance major. That sounds really complicated, but at the end of the day, this business is just adding, subtracting, multiplying, and dividing. It's not rocket science. And yes, we can get into a bunch of complex internal rates of return and discounted cash flows, but at the end of the day, if you can add, subtract, multiply, and divide, you can figure this business out pretty quickly. So, getting the basic construct of what the cash flow is going to be, what the construction budget's going to be, is kind of the basic building blocks of what we need to start to put together a capital stack and a pro forma.
Yeah. So, term of loan, the longer the term, the lower the payments. So give me a quick flavor of the different type of financing and the different type of loan amortization that people do and don't like to have.
You bet. So depending on the profile of the borrower, we have very aggressive borrowers that are entrepreneurial in nature. And we have institutional borrowers that don't like debt, and they want maybe at maximum 60% debt with some amortization on there. So it really depends on the borrower profile. However, most all construction loans would be interest only, priced over a short-term rate like SOFR or Prime. And the longer-term lenders like Fannie, Freddie, CMBS, as you mentioned, Life Company, they're going to price their loans either over the 5-year Treasury or the 10-year Treasury, depending on the loan term. And they're typically going to have an amortization of like 30 years and sometimes 25. And to your point, the amortization is what we kind of look at to set the payment structure. But the loan term has a bullet in there, which just means that in the end of 5 years, you need to go pay them off and refinance with a new lender.
How often do you see a 30-year fixed rate deal fully amortizing?
It's very rare.
Very rare.
It's very rare. And when we would see those types of financings, Mark, would be single tenant investment grade type companies where
long-term leases. Yeah.
Long-term lease to match.
Right.
You and I have talked about a transaction here in town that's going to have a potential 30-year lease where we would go try to put some kind of finance like that in place.
Got it.
Yep.
How important is the sponsor on a deal? And define what do you think a sponsor means?
So a sponsor is the person that is really the conductor of the orchestra, in my opinion. Yeah. And they're bringing all the various parts to the table, whether it be the GC, the leasing team, the management team, the experience in this particular asset type, as well as bringing all the financing together, both debt and equity. And in some cases, the sponsor is or are their own equity, but in a lot of cases, the sponsor brings in third-party equity. So they're kind of the conductor of the orchestra. And in the 27 years I've been in this business, I can tell you from my personal opinion, the sponsor is probably the most important. Probably most. It was taught to me a long time ago, and I'll say this, a bad sponsor can make a good deal bad, and a good sponsor can make a bad deal good. And I've seen that play out, especially in the Great Recession. I was about a decade into my career when 2008 happened. So I had been around long enough to understand the game, but see what can happen when the market turns. And that's where you really got to see the bad sponsors versus the good sponsors and what happened to them. And when we look at a deal, especially on the equity side, I would tell you sponsorship is probably the first thing we're looking at, because the first question, if it's not the first, it's the second or third that I get asked from potential equity providers about a sponsor is, tell me about their last 4 or 5 deals. How did they do? How did their investors do? And what happened to that deal? And if I can't answer that question with an affirmative statement, then I'm done. I'm dead in the water. That call just went to zero in a heartbeat.
So I'm gathering that there are really 3 primary components. It is the sponsor, the deal itself, and then how much equity they put in. Do you think those are the key 3 basic components that are?
I would suggest that you're right on those components. I don't think I was trying to figure out if I was going to order them differently, but I think that you order them the right way.
Okay, so rates have risen over the last 24 months to the point now that with SOFR stands for what?
Secured overnight financing rate.
Secured overnight financing rate,
right.
And that replaced
LIBOR. Which is the London Inter Offer Banking Rate. I can't remember.
Banking rate.
Right.
So LIBOR went away, so they created a new SOFR, and that's what the benchmark that most institutions use. So rates have risen, right? Can you tell me about so as rates go up, that means you have to have more revenue to support those deals or extend your amortization out. Can you tell me a deal that you had to get creative with because of the rate had gone up, and then you had to do it?
So this is happening all over the market right now. If you think about it, Mark, if you were in the market acquiring, let's just say multifamily for purposes of discussion, if you were in the market acquiring multifamily assets between 2021 and 2022-ish, you were acquiring properties with the lowest interest rate environment possible at probably the most aggressive cap rates that we've seen in years. And so a lot of people were utilizing the private capital debt fund market where they could go get 80% of their acquisition cost financed with probably somewhere around a 3% interest rate. As we mentioned before in the podcast, those loan terms are typically 3 years. So now we're fast forwarding to 2025, and those loans are expiring. And those loans are going from 3 into some cases 8 or 9%. And so you asked me a question, how are we getting creative to fix those issues? Well, the borrower or the owner really has two choices at that moment in time. They can either decide to de-lever and continue on with the asset, or they could sell it for whatever they can get it for. Or I guess there's a third option. They can always just throw the keys back to the lender and give it back. And so to answer your question, there's a whole subset of what we refer to as rescue capital that's in the market. And they'll come in and say, look, we will help you de-lever, and we're going to charge you a market based return on preferred equity or mezzanine to fill that gap so that you can hold on to the asset and live to go fight another day, as we say.
What does that cost you?
That's going to cost you anywhere if it's a clean multifamily, it's probably somewhere around 10% interest only. But we've seen it all the way up to 14, 15, 16 in some cases.
So as these deals are maturing and resetting, are we seeing a significant amount of deals get restructured with their existing lender, or are the lenders taking it back and reselling them, or a combination thereof?
So last year we saw the majority of lenders extend, and I'm going to use a term from 2009, extend and pretend. Okay. This year in 2025, we're seeing the lending group start to tell the borrowers you need to go move somewhere else. We're not going to extend anymore. So that's happening as we speak. So the BOV activity for our brokerage firm is at an all-time high. And I'm going to use the same vernacular for the debt capital markets. Our BOV for the debt capital markets is at an all-time high. And what people and borrowers are doing right now is they're going through discovery. And the discovery is, how much is my asset worth if I want to sell it? Or if I don't want to sell it, what's the refi market look like, and what is that going to mean for me? And then they're going to go take that information back to their investor group as a sponsor and say, hey guys, here's the pass we have. What do you want to do? And that's going on right now.
Right. So you underwrite a lot of deals. Some deals don't happen.
Right.
And can you give me an example of a deal that didn't happen and what you learned from as you went through that particular deal?
I'll give you one that's very recent, and it's very apropos to today's times. When you acquire a property in Oklahoma is what we refer to as a disclosure state, which means that the very second that property trades, the taxing authority knows about it, and they will adjust the property taxes pursuant to the purchase price or somewhere near the purchase price the day you close.
That's right.
In Texas, it's different. Texas is a non-disclosure state, so you don't know what the purchase price is. You don't share that with the taxing authority, so they make a guess as to what they think it is, and so the taxes never really catch up to the purchase price. So we recently had a borrower in Oklahoma that was going to acquire a multifamily, and they were going to purchase the entity to avoid triggering a reset of the tax basis, which is a great game to play, except for Fannie and Freddie don't really play that game. And he thought that he was going to be able to get his taxes underwritten at today's valuation. And what he did when he did that, he based it upon all the last agency loans that he had done in his career. And what he didn't understand was while the agency was underwriting property taxes, they were doing so with an appraiser comp set of what the taxing, what the comparable properties were taxed at, and they used an 80% threshold there. We are in a market right now where cap rates are declining or moving up, depending on how you want to look at them. So valuations are dropping. And so this particular seller was selling his property, and the tax basis was already 95% assessed. So we weren't going to get the benefit of the appraisal method where they use 80. And so the junior guy that was running the deal in my shop thought with the tax number he was going to get a $15 million acquisition loan. It turned out to be 13. And the guy that was like, I can't make those numbers work. I have to drop the deal. So this was very fresh, and nobody really has ever experienced this in the last 10 years because multifamily values have been nothing but going up, and now they're starting to come back down. The taxes are catching up there.
The interesting thing that pops in my mind, the pursuit cost on deals, on something like $10, $20 million deal, you're going to spend $100,000, $200,000. pursuing it and really making a mistake like that,
it's an ouchie.
It just costs you $100,000-$200,000.
It's an ouchie.
And you don't own the property.
Right.
So that's
right.
That's a big.
And that's why that's why we say commercial real estate has risk.
Yeah.
Because you don't think about those things, but you're 100% right. I mean, he's got legal fees, he's got all kinds of due diligence costs. And the lender came back and said, this is the best we can do. And he's like, this is $1.5 million short, and the deal doesn't make.
What he could do is put more equity in.
Correct.
Or he could go get
a mezzanine or preferred equity.
Yeah.
So in this case, and the takeaway was, I'm paying too much for this property.
Right.
And so I think his tact was to go back to the seller and see if they would take less, because his financing didn't come in, which means his returns weren't there.
And the seller didn't.
Yeah.
The seller said, no, I'll just hold on to the property.
Right.
Yeah. Gotcha. Yeah, we've been in a situation like that with a property we own in Stillwater, apartment complex.
Yeah.
And we had a set price that we're willing to sell for. We couldn't get that price. We're just going to go to agency financing. Right. And we're in the final stages of securing that agency financing, because we, at that point, couldn't get to that level we wanted to, right? I believe the property's worth it, but given, as you mentioned, where cap rates are today, it just didn't warrant that.
And this is a moment in time, and I think that you're spot on to just hold the property, because if all productized housing of all types has tremendous pressure on it, whether it's for sale or rental, and we don't have enough of it.
Yeah. If you could go back in time, when you first got into the business and change something that you would have done differently, what would that be?
Okay, so I have this discussion with my partner all the time, and our consensus is that I probably, the way that I modeled my career was after a guy that taught me the business, and I became to use a demeaning term, I guess, a generalist in financing for all different property types, okay? Yeah. So that means if you came to me, Mark, I can help you out with a retail deal, I can do an industrial deal, we can do a hotel, and I have experience financing all those types. But there is a subsector of people that are on my team that I deal with day to day that they just decided, you know what, I'm going to go be an agency expert. And they do nothing but Fannie and Freddie. Right. And so they deal with these large institutions doing Fannie and Freddie loans, and it's a widget machine. I mean, it's a commoditized lending, and they bring and it's not easy, because nothing's easy in our business. I shouldn't say that, but it is very predictable. They know how it's going to go. Right. They underwrite to a metric every single time, and so there's very little volatility in that market. And there are some people on my team and in my company that just solely focus in the agency space, and they crush it. And they do really well.
And, we're in the middle of it right now. We've done it before, but it is a very well-oiled machine. It's non-negotiable. You have to fit within this box, and if you do, we'll loan you the money under these terms.
That's right.
And here are the documents, by the way. Yeah. They're non-negotiable.
That's right. That's right. And by the way, in 2009, when all the capital retreated, the government couldn't have Fannie and Freddie go away. They kept the pump primed.
Because their main mission is to support housing in the United States, right?
That's right.
To ensure that people have affordable housing. People should have financing to have a home.
Right. So, now, I'm not saying a bunch of multis were trading in the Great Recession, but you can go get money for it. And whereas other property types, it was good luck.
Okay. Yeah. Let's move into a deal that you and I've done.
Yeah.
It is, I've been doing it 40 years. You've been doing it 25 years. It is the hardest deal I've ever had to put together. Convergence, right?
Yep.
So Todd is the main guy who helped put the financing together. So
I don't know about that.
So we had 8 forms of financing on that.
Right.
Potentially 9.
Yeah.
We'll get into that for a second. So I'm going to list them all, and then you kind of give me what your impression of the complexity of that deal going forward.
Go ahead.
We had bank loan. We had actually 4 different lenders consolidated together, making one particular loan.
Correct.
And then we had CPACE financing, which is environmentally friendly financing.
Correct.
Financing that provided for doing environmentally friendly construction.
That's accurate, right?
Then we have TIF financing. This is called tax increment financing, which is financing that if you take your real estate taxes are X, and then with your development, they're going to be Y. There's that additional tax base.
Or the increment.
The increment of that tax.
Right.
that then allows you to fund some of that increment into your project.
Yep.
We had MAPS 4 money because there was a public facility that was embedded into our development. Then we had the Leverage Act, which is
the leverage lender. Yep.
Yep. And then we had an EDA grant, which helped build out a workforce training center inside the MAPS 4 building, Innovation Hall. And then we had new market tax credits. And then we had our own equity, which
Correct.
was no small feat.
Right.
And we were in the middle of this development as construction costs and inflation hit, interest hit, because early in the conversation you said construction financing is floating.
Right.
So our rate went from what we performed at 5%,
Right.
it ended up at 8 or 8.25 on a $100 million loan.
Yep.
That's a big number.
It's a big number.
It's a big number. And then the ninth piece that we haven't secured yet, and it's still out there, is potentially some EB5 partners coming in
Right.
to do. Give me your take on this. It was
so,
fun.
So I'm going to revert back to an earlier time in this podcast, which is you asked me about sponsorship. And I truly believe that the only reason that deal was taken to the finish line was because of you and your partner.
My
And the
partner
sponsorship.
being Dick Tannenbaum.
Correct.
That's good.
Number one, I couldn't think of two finer individuals for the city of Oklahoma City to shepherd a project that was forward-facing and public-facing like you guys did. I happen to believe, just from my capital markets knowledge, that a lot of what you guys brought to the table from a team perspective mitigated a lot of the inherent risk in the deal for the lending stack that you mentioned.
Appreciate that.
I don't think this deal would have gotten completed or financed without you two, just to be completely honest and frank. So you guys, in turn, made my job a little bit easier.
It's still hard.
Still very hard. And, namely, you named two parts of the capital stack, which really throws sand in the gears of lenders, which is CPACE and new market tax credits. And in both of those scenarios, the way that those two pieces of financings attach to the collateral, if you don't understand as a first lien lender, it can cause you a great deal of concern. And so just by having those two components in there probably eliminated, I'm going to guess, 50% of the lenders that otherwise would have looked at a deal like that, just because they didn't want to deal with those two pieces of the capital stack. Right. So it's probably one of the most complex deals I've ever worked on in the 26 plus years I've been in this business. Your team did a masterful job of bringing all of the city components to it, to allow me and my team to focus on a lot of the debt components. So when you ask me about all these different pieces of the capital stack coming together and keeping it moving forward, there's a portion of that, and a good portion, that you and your team just handled outstanding, that I didn't really have to get into because of what you guys brought to the table as a sponsor.
On a deal like that, it's a partnership.
Yeah,
we
no
have
doubt.
to work in sync because of the
no doubt.
size and complexity of that.
And we had, and let's not forget the fact that you guys were coming out of the ground in an environment, like you mentioned, where rates started rising. Your construction costs weren't going down. If anything, they were slightly going up. And the elephant in the room was what's going to happen to office post-COVID.
Right.
Now, you and I both know that's not traditional office. However, you and I also both know that perception's reality.
That's
and if a lender sees the word office, they're just going to dismiss it summarily because of the factors I just mentioned. Yeah. What we really had to do, and what you guys were so great about helping us do, is explain to somebody this really isn't traditional office. It's in an innovation district. We're commingling with all these other factors. And we had a huge chunk of pre-leasing, which mitigated and substantiated the need for it. And so getting people to listen to that story and uncover the deal the way we saw it was challenging, because they just saw office construction and they just, then you start layering in new market tax credits and CPACE. I'm like, guys, we've got better things to do. And so truly, you guys as a sponsorship team, allowed me to open up some doors that I don't think would have been opened had it not been you and Dick.
So it gets back to the three components. How much money you're putting in.
Mm-hmm.
Who are you and what's your experience, your
Yep.
ability to really make the transaction work.
That's right.
And then the deal itself.
Right.
Is that what a lender really wants to participate in.
That's
So
right.
Get back to those three basic fundamentals.
That's right.
All
That's
right.
right.
So capital markets, it's an evolving. It seems like in my 40 years, we've gone through 3 or 4 different cycles.
Yeah.
So the capital markets
Yeah.
have come and gone and stuff. What should we be looking for in the next 12 to 18 months? What are some trends or some things that you think are going to affect our ability or financing in the next?
Sure. So I'm going to tell you, we touched on this, that the proliferation and the just dominance of the private capital is going to be here.
Okay.
It's going to continue. I do think that the banks are going to continue to struggle. And the reason for that is when interest rates started going up, a lot of deposits moved out of those banks and into money market funds. And when the deposits decrease in a bank, their ratios of deposits to commercial real estate loans gets out of whack, and it causes them to not be able to make loans. And so the private capital has stepped in to fill that void. The problem is that their capital is more expensive than banks. And so getting those deals to work is what's caused this other sector of capital with the rescue capital coming in to fill that gap that you need. So I will tell you that in the next 12 months, you're going to continue to see private capital be very liquid. Mm-hmm. They're hungry for deals. I think the securitized CMBS market is probably last year had its best year in the first 5 years. It's going to have another really banner year this year. And I think that you're going to start to see joint venture equity creep back into the market at some point in 2025. Right now, it's very sporadic. And the real reason for that, Mark, is it's hard to tell your equity what the value of your property is today.
Right. When you say joint venture equity, describe that to me.
So joint venture equity is equity that comes in alongside a sponsor to complete the capital stack. It's what I mentioned earlier when a sponsor controls, and he's the maestro for the orchestra. Part of that is bringing in third-party equity, and a joint venture partner is somebody who would bring that for a particular developer or client.
Are you seeing any financing source, i.e. a life company, be that joint venture partner as well as provide the debt?
In some cases, but that would be a very special situation in a major market with a major developer building an asset class that's favored, like multifamily or industrial. There are life companies that have equity sides of the bucket, but they're very conservative, as you would surmise a life company would be and should be.
Yeah. So over the last 5 years since COVID, I still can't believe it's 5 years.
I know.
COVID's 5 years.
5 years ago, I saw yesterday, 5 years ago is when they shut down the Oklahoma City Thunder game.
That's right.
That was 5 years ago yesterday, I think.
Oh, was it really?
Yeah.
So 5 years.
5 years.
So over that 5 years, as you know, I'm heavily into the high-rise urban core office environment. We're fortunate that we have good portion of our debt in the LifeCo debt, so we've got long-term financing, fixed rate in place. So we didn't have that much exposure. We did have a little bit of exposure from an occupancy standpoint.
Sure.
But is office coming back in favor, especially with the federal government, and here in Oklahoma, our state government got mandates to go back to work.
Yeah.
As well as we're seeing large corporations say, this work from home stuff, yes, it works in some form, but it's not good for our business.
So 6 months ago, when capital would come into our shop, we probably have a capital provider a week come in and explain to us, this is the deals we want to see, this is the money we have, this is the cost. If we ask about office 6 months ago, they would say we don't have a home for it. Fast forward to today, every lender that I see is like, we'll look at office and we will make office loans. And so the market is waking back up. Capital's coming back into space. And I can tell you from where I sit in Dallas, and I'm sure it's very similar here in Oklahoma City, we see the have and the have-nots in office. If you're Class A, highly amenitized, you're doing just fine.
You're doing fine.
And there's plenty of capital for you. You can go get a refinance. Or if you're like that C- office that's got monthly payers, there's, I don't want to describe the tenant, but, they tend to do very well and stay very full. It's that middle kind of B space that's struggling in the market right now. Yeah. But here's my thoughts on office. And I believe this to be very true. Office is not dead. It's just reinventing itself right now. Yeah. And there are some companies who have figured out, you know what, I don't need that much space, but I do need space. And that's, unfortunately in the office market, most leases are 10 years in length and sometimes longer, as you know. And so it's going to take time for those leases to roll and for these tenants to understand what space needs that they have and what they're going to do when that lease rolls. And so for that reason, you have a lot of people on pause in the office market because they want to see what happens. But this to me reminds me of when Amazon got big into the home delivery and everybody said brick and mortar retail is dead. Yeah. And it was never dead. Never did. It just reinvented itself and it became experiential. And now the retail is the new multifamily. Where we have capital out the wazoo for retail right now because the lack of new development retail has caused occupancies to just increase all over. Yeah. And look, COVID kind of wiped out all the bad retailers, the people that didn't have fortified balance sheets that couldn't make it through. So what's left in the retail community is mostly strong tenants with a lack of new development. So we've got lenders chasing us down for retail. And 7-8 years ago, we had people saying, don't bring us a retail deal. It's dead. Amazon's going to kill it. And I think office, when we look back, maybe it's 2 years, maybe it's 5 years, we're going to laugh and say that was so stupid. Everybody thought they were going to work from home. Office was dead. It is not going to be. I think it's going to be, but you just got to make it to that end.
Yeah, so you touched on two of the food groups, office and retail. Let's touch really briefly on the other three, which would be industrial, hospitality, and mini storage.
Okay, so mini storage is an interesting product type. It's underwritten a lot like multifamily, and we see that self-storage has been really prolific the last 24 months, especially in times where people can't afford a house, which is kind of going on right now. So they may want to be a renter, and they go and get a self-storage facility to keep all their extra stuff. And I think you and anybody kind of can think this through. Nobody wants to move their stuff out of self-storage once they get in there. It's just stay in there. You keep raising the rents $5-10 a month, and nobody seems to want to mess with it. So it's been a preferred asset class since COVID. Industrial has been on a huge tear and a huge run.
I don't see it stopping.
I don't see it either.
The onshoring. I mean, recently
the onshoring and nearshoring is real.
Yeah.
Manufacturing is coming back. You and I have had witnessed some of this just in our own backyard.
We have 2 or 3 deals working.
That's right. That's right. So I think that is real. I think it's going to continue. What's interesting is we're seeing a lot more manufacturing than just traditional industrial based upon all this, which is, historically speaking, we wouldn't go finance something with a bunch of FF&E in there. We're starting to see more of those requests come in now, and it's different. So I do know in Dallas that the 1 million square foot tenants are slowing down, and the smaller spaces are the preferred, like 250 to 500,000. So we have seen a little bit of a slowdown in the absorption. I too think that's short term. As I mentioned before, retail. There was a brief time that I kind of viewed industrial as the new retail because take Best Buy, for example. When Amazon came into play, Best Buy reduced their footprint and realized, we don't have to have 30,000 square feet anymore. We can do this out of 10 or 12 and then have more warehouse space and do just-in-time delivery. So that made the industrial market really, the online sales really made the industrial market go crazy. And so I think, to your point, that's here to stay. But we have had a lot of building, and I think it needs to absorb a little bit. But long term, it's going to be just fine, and there's going to be a continued need for more development in that space.
And last but not least, hospitality.
Okay, so hospitality, I'm going to use the same pitch that I did on retail. I had had a meeting with the CEO of a Dallas bank that wanted to pick my brain about where they should be deploying their capital right after COVID. This was probably like early 2021. And I told him, you should make as many hospitality loans as possible. And he looked at me like I was crazy. He goes, why would you say that? I go, well, for two reasons. One, you can name your price because nobody's lending in the hospitality space. I go, number two, COVID has wiped out all of the weak operators. Yeah. They couldn't make it. So what's left that you're going to loan to are the very best operators that know how to weather a storm, probably have a very good flag, and the hospitality market is going to come roaring back when it does. So you better get in now because typical hospitality loans prior to COVID were in some cases 75, 80%. You could go in post-COVID and do a 65% loan, and people would have been tripping over themselves to get that money.
I mean, as you know, we took that same tack.
Yeah.
We bought 10 hotels.
And that was the right time.
We bought 3 in Oklahoma City, 1 in Tulsa, 1 in Charlotte, 3 in Chicago, 1 in New York City, and 1 in Minneapolis. And the prices were favorable. I mean, we got cents on the dollar. And now, the challenge getting back to financing that we really haven't touched on is guarantees.
Yeah.
So every piece of debt has some level of collateral security that needs to happen.
Yeah.
And that collateral comes from the property itself, and in some cases, from who? The sponsor.
That's correct.
Sponsor needs to sign those guarantees. I would tell you, in all of our deals, 9 of the 10, we had to sign on the dotted line. We had personal guarantees on those because of the risk we're taking.
Right.
But we believe the reward was there, as you're saying, because they were here, we're buying here.
The basis
it's
reset.
going to get back here. And one of the tactics that we took was inflation had caused values to go up with existing product because of the replacement cost to new stuff. So at one point when it was $400 a key to build, now it may be $500.
Right.
And if the value was here but you're buying here, that spread is tremendous.
It's tremendous.
Yeah.
And let's not forget one other piece which was critical during a inflationary time that we've just been through, which is on a hotel, you get to reprice your rent roll every night.
Every night.
So you can keep up with inflation, whereas you could not in an office building or a retail where you're locked into a lease term and expenses might run from you. Retail, not so much because it's triple net, but on office, as you've probably experienced.
Well, you bring up a great point because that's also, I'm glad you mentioned that, because that's one of the reasons we wanted to get in the hotel business was the ability to capture inflationary rents on a day-by-day basis.
That's right.
Okay, we got to wrap up here.
No problem.
So Todd, couple of things. If you would give any advice to anybody out there that wants to get in the business, what would that be?
Now's the time. I got into this business in 1998, and really shortly thereafter, the Russian ruble collapsed. And I was as green as the grass out there, and I was thinking to myself, what does the Russian ruble have to do with what we're doing here in the United States? And I quickly learned when Lehman Brothers and Bear Stearns and Nomura started pulling all the loan apps saying we can't do this deal anymore because the market went wonky. And so I preceded that by the tech meltdown in 2001, the dot-com bust. And then we had 9/11. And then we had 2009. And what I can tell you is when there is a dislocation in the market, and I've seen a handful of them, those borrowers and clients that I did business with that continued to power through and do new deals in those cycles were greatly rewarded. And right now, as a college graduate, you might be thinking to yourself, I don't want to go into commercial real estate because it's horrible right now. But what I can tell you is commercial real estate is definitely cyclical, and what goes up must come down, and what goes down will go up. And if you're graduating right now, you're going to start learning the business in what is a difficult time. And by the time you really get your sea legs and you know what you're doing, the market's going to be coming back up and you're going to ride that wave. And so I would tell people, now's the best time to get in, even though it may not look like it.
Great. Todd, you've been awesome.
Well, thank you for having me. It's a pleasure and an honor.
Yeah, thank you. Thank you for this. So the real op of the day is sponsorship. Gain experience and become a good sponsor, be well known, your reputation is all you have, and have good relationships. And as Todd mentioned, underwriting the details is vitally important to ensure you have a successful project. Thank you.
Yeah. Thanks for having me.
In our next episode, we'll be joined by Dick Tannenbaum, a close friend, business partner, and owner of Gardner Tannenbaum Holdings, to discuss how he has formed immense success in the real estate investments and developments across the United States. We hope you enjoyed our discussion today and learned some things along the way. Remember, the day is what you make of it. See you in 2 weeks.